So, welcome back, continue our discussion about the credit models. One model which we thought and I particularly thought I should discuss separately is the KME model. So, before that I will give you a simple background. So, techniques for quantifying credit risk would be econometric methods, it can be game theoretic methods, it can be neural network. Neural network is utilized in a very big way in trying to analyze these models. You have the optimization models, some of them I have discussed in very brief, like safety first principle, ratio of excess return to beta, ratio of excess return to standard deviation, then the Markowitz model, then the robust optimization model. Though fleetingly I did not go into the actual mathematical details, because that is very in depth analysis and that cannot be discussed in such a short time, considering that we are trying to give you overall view or overall very good knowledge about the different type of quantitative techniques which are used, rather than going to depth in any one of them. So, obviously, that can be taken as a more specialized part of trying to analyze reliability models, robust models and stochastic models. You have the expert decision system support system, which can be built up depending on what you think are different type of ratios which should be considered and what weightage should be given. You have the hybrid system using direct computation techniques, simulation techniques. You have the different meta heuristic techniques, which is genetic algorithm, simulated annealing, taboo search and colony optimization and so on and so forth, which are given here. Now, the corporate credit models which we will consider is the leading example of stock market based credit models is the expected default frequency model or the EDF model of KMV Corporation, which came out in 1995, which was basically a San Francisco based model, a firm that sold credit analysis software and information product to financial institution, and in 2002 the company was brought over by Moody's. Now, it is basically, if you do a search, it comes as a information as KMV under the Moody's. KMV Corporation has created an approach for estimating the default probability of a firm that is based conceptually on the Merton's 94 approach, which basically gives you that how you can analyze the company given the different type of fundamental and the financial ratios of the financial principle of the company. The starting point of this model is the proposition that when the market value of the company drops below a certain level, the firm will default. So, it is basically works as a very simple option. You exercise the option of a default if your value falls below, and if the value is more, obviously you would not exercise the option. So, if you recall the concept of options. To understand this model, we need a background on the option theory, which we have already discussed, and we must remember that the work of Modigliani and Miller is the area of corporate finance is considered the base for option pricing theory. So, Black-Scholes model, if you remember, before that the concept of Modigliani-Miller concept wise may be utilized in order to analyze the Black-Scholes model. So, again I am mentioning the EDF KME model is basically like an option, conceptually like an option, which can be utilized in order to find out the price of that particular default. That EDF model works on 3 steps. The market value and the volatility of the firm are estimated from the market value of the stock. That means, whatever information you have from the market. The volatility of its stock and the book value of the liabilities are also taken into account to find out the market value and the volatility. Also, an expected firm value is determined from the current value firm's value. Using these 2 values mentioned in step 1, the firm's volatility, a measure is constructed that represents the number of standard deviation from the expected firm's value to the default point. This is what is important. If you remember, in options we had a strike price. So, if the strike price are more or less, depending on that, basically the person who is the buyer and who has the obligation that he can exercise the option will exercise that. So, that is the triggering point on the other default point which you are considering here. A mapping is determined between the distance to default and the default rate based on the historical default experience of the firm is calculated and can be analyzed. In case of private companies for which stock prices and default data are generally not available, KMV uses essentially the same approach by estimating the value and the volatility of the private firm directly from the observed characteristics of the accounting data, which means again balance sheet, profit and loss account, trial balance are important. So, if a company is in a market where the actual information from the financial ratios or the profit and loss account, the balance sheet are giving you the exact information, then without analyzing them you can use the stock market. In case in the stock market information is not available, then you will sit down with these ratios or this information which is given in the balance sheet and the profit and loss account, and then try to analyze that. The starting proposition point of the KMV model is that when the market value of a firm drops below a certain level, the firm will default in its obligation. So, this is the graph which is there. So, let us spend some time in this graph. Again, the distribution which you have analyzed is a normal distribution. What is normal, you may be asking? This is the normal distribution which I am talking about. So, this is normal distribution. So, you may be talking about what is this normal distribution. So, I have just turned it 90 degrees, that there is a reason for that. So, let me first erase this. So, now consider the time frame along the x axis, this is time, and the market value of the firm along the y axis. So, the market value being more or less than a default criteria or default point, it is below that the firm will default, over that the firm won't default. Now, consider the firm's business is increasing, which means that on an average the firm's net expected growth of the futures asset is happening at a standard rate, which is the dotted lines. Now, if you see the dotted lines is passing through the mean value or the mode value or the median value of the firm at time t is equal to 1, which is I am basically trying to highlight here. So, consider this is time 1. So, if I have the performance of the firm as it proceeds with the time, then it may be possible that the firm overall expected value here is like this. Or if the firm, if I consider the firm's overall performance, let me consider here, this is like this. So, they are normal, they may not be the same variance, but I am trying to give you a picture that how the overall performance is. So, if I let me again erase it. So, now what we are saying, we are taking a snapshot of the company at time t is equal to t1, this value. And as the company progresses, this normal distribution considering the variance is same will shift. It will shift up or down depending on what is the net value growth of the future of the firm. Now, consider this, the debt service requirement is we are taking as a step function, this one. Why it is, it need not be a step function, but we are considering the company is borrowing at a certain interval of time. This is the interval time when it borrows the second time. At some time in future it has borrowed some money, and the interest rate payment are based on a fact that they have been fixed at a fixed interest rate. Hence, we are considering this is the increase in the service requirement due to an extra burden of a debt the company has taken or the liability has the company has taken. Now, this curve which I denote is the probability density of the future asset of the value of the company, and this area which you are considering is the standard deviation. So, now we are considering very simply the standard deviation is not dependent on time. So, the curve remains as it is, but only shifts, and the mean value of the asset value at time t1 is this, and the mean value is changing depending on the net expected growth of the future asset of the company. So, now if I draw it, so this hashed area which I am marking now with the red bold part is basically default, because if the net value of the company is below this debt service requirement, the company will default. So, what I need to find out is that with respect to the probability distribution, what is the probability of default. Now, in case if I need to find out the probability of default of the company, considering that the variance has increased and the increase in the debt service requirement has also been there, I will try to draw a graph now on the same one. For first, let me delete it. So, consider the company's net expected value has increased. So, let me draw the curve. Consider also very simply the variance has also increased. So, let me draw first the mean and the standard deviation, and this is the variance. So, now if you consider this value, the variance here of 2 standard deviation plus 1 minus 1, and if I want to have a study of the variance of this portion, so this is the standard deviation. So, let us consider this standard deviation and the one which you have here are different. Now, if you consider the EDF which you value of here and the expected value which you here, they are different, which means the value of the expected probability, the probability default is different for the case for 3 different reasons. Number 1, net present is increasing. Number 2, variance are different. Number 3, the debt service ratio is changing, or the debt service requirement. So, what we need to find out is the probability at any instant of x. X is the random variable which denotes the net this value of the future value of the assets. X is greater than equal to some x, where the small x is basically debt service requirement, and you want to find out what is the probability value, which is beta, which we need to find out. Now, what can be done very simply is probability of x minus the mean value would be here for the time period t1, mean value would be here for the time period of t2. So, remember that the mean values are changing, divided by sigma. What is sigma? Again, this is the ratio, this is the standard deviation which you have at time t1, this is the standard deviation for time t2, this is the standard deviation, is greater than equal to some x minus mu. This x value at time t1 is this x value at time t2 is this. So, that will change depending on where you are by standard deviation. So, this is what we know as standard normal deviate, and using the standard normal deviate tables you can find out the value very simply from the table. So, it means that given these values you can easily find out what is the probability of default. This in a very simple nutshell is the way we basically try to use the EDF model of the KMV Corporation and try to analyze what is the probability of debt of a company, or what is the overall default of a company. So, now coming to the actual steps, this was what I was trying to explain. Step 1, a firm with publicly traded share, the market value of the equity may be observed, and the market value of the equity may be expressed as a function of this book value of liabilities, the market value of assets, volatility of assets, the time, and the risk less lending and borrowing, or the risk of the total amount of money based on which you are trying to analyze your debt, or you are trying to analyze your default. KMV uses a special form of option pricing approach, that is proprietary. As you remember, we did mention about the concept of that being a concept of option, but the way they try to price this option is not known to us. I was not able to find it in any place, and they use the Black-Scholes model in order to find it. So, once you analyze the Black-Scholes model in a very simple manner, your market value of the equity is given depending on the variables which are market value assets, time horizon, risk free lending borrowing, standard deviation of assets, and the cumulative normal distribution factors, and D1 and D2 which are given. You can find it in any book. Based on that, you have the market value of the equity, which is the option value, based on which the option will be exercised if it is defaulted or not. In equations 1 and 2 which are discussed, there are 2 unknowns which are V and sigma A. We differentiate and then take the mathematical expectation on both sides. Thus, at the end we will basically have the sigma, which is the sigma of basically the equity, and the equity values would be given by depending on book value of liabilities, market value of assets, volatility of assets, time to expiration, when it will basically default, that is according to the concept of option if you try to analyze, and you have the risk free interest rate. Again, using Black-Scholes model, you find out a different way of trying to analyze the standard deviation of the equities, and they are dependent on the factors which is cumulative normal distribution, market value of assets, cumulative normal distributions function which is calculated using D1 or D2, whatever is there in the last 2 slides. The volatility of the assets. Now, in equation 2 and 4, the unknown values are E, standard deviation of equity, D and T, and these unknowns can be found out using the simple information which you have already from the these fundamental principles of the balance sheet, profit and loss account, and the trial balance of the company. Next, the expected asset value at the horizontal and default point are determined. Now, remember an investor holding asset would expect to get a payoff plus a capital gain, because obviously it means that the price which has been paid, which is the price small p or small c, if you remember, is basically somewhere based on the triggering point where the default will happen. Using a measure of the asset systematic risk, KMV determines an expected return based on historical asset market returns. This is reduced by the payoff rate as determined. Now, continuing, given the firm's expected value at some time horizon and its default point at the horizon, the percentage drop in the firm's value that would bring back to its default stage is determined. Dividing the percentage drop, we trying to find out the number of standard deviation it is away from the default point. So, how far it is from the default point, which is our main concern. Obviously, probability default is important, considering you are trying to find out the pricing from the option point of view, then finding out the pricing from the option point of view, you try to analyze the distance to default. So, which is what we are mentioning, DD is the distance to default, it is given by the expected value, market value of the firm by the default point by divided by the volatility of the assets. So, what you are trying to do, you are trying to find out the normalized distance to default. Given the normalized distance to default, if there are different type of firms in different sectors, you can find out what is the normalized distance to default and try to base on that you can find out how far or how close the firm is from the default point, given all the set of informations have been normalized using the distance to default concept. Consider that at time t is equal to 0, which is as present the expected value. So, for this always consider the graph which we have discussed. The average value is increasing this way. So, you will try to analyze whether the variance is increasing or decreasing, the mean value is increasing or decreasing, and what is the default value which is there. So, these are the changes of the default which you already discussed. The expected market value of the asset of a company is 200 crores and its debt service requirement is 50 crores. Assuming normal distribution for the asset value, we also know that the standard deviation is 15, then we can also find out the distance to default very simply as 0.05. We may now be interested to find out what is the value of the distance to default at time t is equal to 2 when the debt service requirement is 100 crores. The net expected growth of the asset has been given by 15%. So, a simple calculation will give you the distance default is now 0.04, which means it has decreased, and there may be instances where the rate of change of the net present value or the rate of change of the net default would increase or decrease depending on that is distance would increase or decrease depending on whether the debt service values are increasing or decreasing, or whether the standard deviation is increasing and decreasing, or whether the average value is decreasing and increasing. By the average value I mean this, by standard deviation I mean this, and the debt service basically means this. So, these are the important points, and then obviously you consider from the simple Black-Scholes model what is the actual value of the option based on which the triggering point will happen. Remember that in this above calculation we assume the standard deviation remains fixed as the value of 15 crores, which is definitely not true in the practical sense, because it may change depending on how the company is doing, or how the overall market share of the company is changing, how the overall business scenario is doing, and so on and so forth. Calculating the market values of assets. So, equity derives its value from the cash flows of the firms. Equity is also basically a type of call option on the firm's asset, the right but not the obligation to buy the firm's asset from the lender by prepaying the debt. So, on a standalone basis, the standard option terms we are trying to analyze and try to basically bring a one-to-one simile with the KMV models are call option prices is the market value of equity, and the strike price is basically the book liabilities, book value of the liabilities based on which you are trying to do the calculation. And the implied underlying asset value is equal to the implied market value of the assets. So, why do we calculate the distance to default? It is basically a measure of the liabilities due to the event in the firms if it is in distress. Non-cash and long-term obligations put less financial stress on the firm, and it can be analyzed in a very nice manner in the distance to default and the probability of default. Firms often increase leverage as they deteriorate. So, obviously, they try to change the overall liabilities, overall scenarios or long term and short term, but this when it is normalized it gives you a better picture. The default fund captures the point where the difficulty forms defaults, and you can find out in a very nice manner even in the case if the firm is changing its overall leverages, that normalized score would give you, normalized means distance score would give you a much better picture how the scenario, even they are changing, there can be normalized and you can find out the distance to default. The assets volatility basically measures the uncertainty around the market value of the business, that reflects the degree of difficulty in forecasting the future cash flows, quantifies business risk. The larger firms in the same industry tend to have lower volatility and compensated by deleveraging the equity volatility such that the distance to default is normalized in a now rational manner. A company with a current EDF credit of 2% has a 2% probability of default within the next 12 months. If we create a portfolio of 1000 companies on an average 20 default, that means 980 do not. That means 2% basically is giving you the probability of default. A company with 2% EDF credit market and 10 times more likely to default than a firm with 0.2% EDF credit measure. That means the distance measure we are trying to use has been normalized. So, this we are taking from 20 and for the last 29 years, starting from 1973 to 2001, the data which I found from the KMV Corporation. These are some of the data for 4,900 defaults. So, the number of defaults using the years are given such that they give you a good picture. So, now before we go into the extension of the KME models, I will try to basically again wrap up this session. And remember the credit models which you have considered, the Zafren models, the Zimnesky model, the Zeta score, the Z score, all these things give you a very good picture that how you can analyze in a very nice manner giving the firm's fundamental principles. And then KME model which is by Moody's are now being utilized in a big way if you can analyze the firm. But the underlying fact which I want to stress is that if you are able to find out the one-to-one similarity between the option pricing concept and the KME model, that will give you a much good better picture. And obviously, probability to default and distance to default are considered as the main focus area, which are the bullet points of the statistics based on which you can analyze a firm whether it is defaulting or not. So, I will end the class today and thank you very much, and we will continue the discussions with the credit models and other topics as usual. Thank you.